Welcome, everyone. Thank you so much for joining us for today's Appraisal Buzzcast. I'm Jim Morrison, and today with us we have Joan Trice, CEO of Allterra Group, and Bill Black, the author of The Best Way to Rob a Bank is to Own One. Bill is also the Associate Professor of Economics and Law at University of Missouri, Kansas City. We'll be discussing mortgage fraud and looking back on 2008 and figuring out what we can learn before going forward. Joan, I'll hand it over to you.
Thank you, Jim, and welcome, Bill. It's good to see you again. And you were quite a hit. We've had you speak at Valuation Expo. I can't remember what year that was, but it's good to see you again. So, Bill.
Great to see you.
Yes, good to be seen too. So you are the fraud expert. Let's just dive right in with the F-bomb there and talk about that gnarly subject that seems to plague the appraisal space since its inception, really. We've made some attempts to stomp it out, but unsuccessful. Why do you think that is?
The incentives are bad, and the power is very asymmetrical in favor of the crooks. So appraisers are my favorite profession in that no other profession fought back as consistently and courageously against the epidemics of appraisal fraud in both the savings and loan debacle and the great financial crisis. Indeed, in the savings and loan debacle, honest appraisers were pretty much our only allies once Chairman Volcker left office.
Right. So I have another question for you, and it's one that's really always bothered me because, we have various checks and balances in place. And during the housing crisis of 2008-9, I was always stunned at the failure of the regulators. Certainly, appraisers knew that this was going on. I mean, we as a company, we were holding fraud conferences frequently because arrests were being made and through the run-up period, 2005 and 2006, things were really getting pretty gnarly. Where were the regulators and why did they fail us?
Okay, so a long story on that. I'll try to keep it to a short version that fits the format of this kind of interview. The regulators, like me, had left government. I left government in 1994 when the Clinton administration came in. And by the way, I'm a Democrat. So their big thing, Clinton and Gore's big thing, domestically was reinventing government. And so they came out. I was in the field as a regulator, a pretty senior position. And they trained us that the big thing we were to do under reinventing government was to treat the industry as, and I quote, our customer.
Ooh.
And to refer to them as our customer. And think of them.
You were there to serve.
We were there to serve the industry. And in my own quiet way, I got up and said, surely you mean the people of the United States of America. And they said, no, we thought about that, but, decided against that. And so I can't think of any quicker phrase, more concise way to destroy a regulatory system, a rule of law.
Right.
Than that phrase. So I left at that point, went back to school when I was 40 and got a PhD in criminology. And, I had been doing applied criminology.
Right.
As a financial regulator for a decade before that in the savings and loan debacle. Now, there were regulators still in the government in 2005, for example, who were trying to do the good fight. And so that when I came out in 2005 with that book that you mentioned, they set up deliberately a book talk in Washington, D.C., and where they were based. And they used that as a way to ask me questions on C-SPAN C-SPAN broadcast the book talk about, is there a bubble and is there a fraud epidemic? And I said, yes, and yes. You can go look it up on C-SPAN, type of thing. But they were, they couldn't say it openly themselves. They had to do things like that because their bosses were precisely the bosses that we had put into exile in disgrace because they had recommended this cowardly surrender to Charles Keating. So if you have listeners who are old enough to remember the Keating Five, Keating was the most notorious fraud. And he wasn't just looting Lincoln Savings and Loan and causing the biggest losses there. He had more political juice than anyone you can imagine. So he got the 5 U.S. senators who became known as the Keating Five, plus the Speaker of the House, Jim Wright. And they infamously met with us in the Keating Five meeting on April 2nd, 1987, to try to coerce us to withdraw our recommendation that Lincoln Savings be placed in conservatorship. We refused to give in to that, but then Ed Gray's term ended as chairman, and the new guy, Danny Wall, was put in knowing that he was going to surrender to this kind of political power. And so this was among my many career-limiting gestures, as we referred to them, CLGs, was blowing the whistle on these 5 U.S. senators and the Speaker of the House. By the way, 5 of the 6 of them were Democrats. And I had 3 colleagues, and I say this one thing to make people feel better about how the government can work. To this day, I don't know what political affiliation, if any, my 3 colleagues had. Politics simply were not, we knew politics was being used against us, but none of our decisions were in the least bit political in those circumstances. And as I say, really the only allies we had were the honest appraisers. And if you're really old, you will know this is the R41B controversy.
I remember R41B, so I guess that makes me really old. Well, let's do this, Bill. Let's take a quick break for a commercial message and we'll be right back.
Remote Val Desktop is here. With added floor plan and measurement functionalities, desktop appraisals have never been faster, easier, or more trustworthy. Remote Val keeps you in control of your appraisal while gathering accurate information, photos, and measurements, all through the homeowner's smartphone. There's also a live recording function, enabling you to record the inspection and revisit the home whenever you want to. Incenter pays you that same full fee for Remote Val inspections. Remote Val is fast, easy to use, and completely free for appraisers. To see a demo of Remote Val in action, visit incenteram.com.
Welcome back, everybody. So, Bill, again, let's do a little refresher course for our audience. The 3 C's of the mortgage process, what are they and how are they used and abused?
Right. So in secured lending, there are 3 C's. Unsecured lending doesn't have one of them because one of the C's is collateral.
Right.
And collateral is exactly where appraisers come in, because typically these big real estate loans are exactly that. They're secured by the real estate, and the experts in valuation obviously are appraisers. And I won't take through the, any appraiser knows the 3 approach to value and how that's used in particular classes, but that was a big deal. In the savings and loan debacle, it was overwhelmingly commercial construction loans. So, income approach was obviously dominant. But then, as we'll see, in 1990, Orange County, California, a new fraud scheme emerged. And this one used home loans. And so their comps would have been the primary emphasis, obviously, in approach to value. So in addition to collateral, there's credit. And of course, that's credit score, basically. But the third is capacity to repay the loan. Now, It's a more complicated thing. It involves liquidity, but overwhelmingly, it involves income, particularly in the context of an individual purchaser of homes. And that's going to be a huge part of the great financial crisis story when we get to it. And again, that story begins in 1990 in Orange County, California. But here's the key. We realized that we, the federal regulators of savings and loans, had a unique advantage over everybody in having the best early indicator of looting that was sure to lead to catastrophic failure. So this is looting by the insiders actually running the savings and loan. And this happened right around exactly 300 times in the savings and loan debacle. By the way, it's about that number in the great financial crisis as well. It's just that the institutions are much larger by the time of the great financial crisis, because they were allowed to expand at roughly 50% annually for 14 years to get to that monumental level once regulation died and once they ended up in the shadow financial regulatory sector, which had virtually no regulation. In any event, as regulators, our key advantage is examiners. And examiners do many things, but the two principal things they do is they look at a judgmental sample of the loans and look at the actual underwriting. And then they contrast that with the written underwriting standards. And we discovered that when you secretly abandon systematically your written underwriting standards, that is the best and earliest indicator that is you are a fraud. And so while those looters were reporting record profits, Lincoln Savings, for example, reported it was the most profitable savings and loan in the world, we were prioritizing them as certain frauds that we needed to be able to investigate and prove and shut down as quickly as possible. That is 180 degrees from modern regulators who took the reported earnings, treated them as if they were real, because they couldn't believe that CEOs could actually loot a bank, which is preposterous, since throughout banking history, that's been the leading cause of the worst failures. And in addition to my hat as a regulator on underwriting and its critical need, I was a banker, right? The Federal Home Loan Bank of San Francisco was their general counsel, sat on their credit committee, and not just on legal issues, because I understood credit. And the key in all of this is, you're dealing with someone that is either dishonest or hopelessly naive about banking if they think that the underwriting process is a cost center. It's your profit center. It shows you when you can make a loan safely and at what price you would need to make that loan. So when people destroy the underwriting process, when I say people, I mean CEOs, that is a sure indication that they're going to loot the institution.
Wow. Well, that kind of leads me into the present. So I was recently at a risk summit. This is a very high level chief risk officer level conference. And I won't name names or embarrass anybody, but there were some government entities on a panel discussing the current crisis that we're at the beginning of in housing finance. And I was a little bothered by a few things. One, they actually admitted that they were concerned about their models that they're using for their automated underwriting systems, because the models were tested and calibrated during a period of time when the markets were only going up and going up at a rather rapid pace. And they admitted that they didn't think that their models actually worked in the current environment. So that gave me pause, but I asked the panel if, since some of the agencies want to get rid of PMI, they want to get rid of FICO, they want to get rid of title agents, and they want to get rid of appraisers, what checks and balances are left in the system? And I'm surprised I wasn't escorted out of the room. Your thoughts on that?
Yes, there's nothing like the person that holds up their hand and says, wait a minute, I think I've heard this story before.
Yeah.
And I remember how it ended.
Right.
And that was catastrophically bad. Okay, so to loot, what you need to do is inflate asset values. How do you inflate the value of financial assets? You massively understate their risk. In the great financial crisis, what were the two enormous ways of understating risk? One, inflate the borrower's reported income. That was liar's loans. That wasn't the borrower putting in fake numbers. They didn't know the ratios that you needed to hit. That's the loan broker,
Right.
incentivized by the lender, and no one made them use loan brokers.
Right.
Incentivized by the loan broker to inflate massively the borrower's income to make the loan appear to have a much better debt to income ratio and therefore be safer, and therefore the financial asset to be worth a premium, right? As opposed to a loan that is a sure loss. The second way, of course, to do that is by inflating the appraisal. And that brings us back mostly to loan brokers, not exclusively, but mostly to loan brokers. Again, extorting appraisers to inflate the value, and what we refer to in the criminology biz and in economics as creating a Gresham's dynamic. Now, Gresham's dynamic is when bad ethics drives good ethics out of the marketplace because you gain a competitive advantage by cheating.
Right.
Every honest appraiser knows this, and this is why the appraisers with the petition in 2000, and it's really a 1998 effort, and by 1998, because all of the banking regulatory agencies and savings and loan regulatory agency, when there was one, had chief appraisers, they all knew by 1998 at the very latest. Now note, that's a full decade before Lehman Brothers goes down. So this was the easiest crisis to avoid in history. And now they want to repeat it, except make it even bigger and badder, and supposedly to save a few dimes in the process by screwing up the loan underwriting in a way that already failed in the great financial crisis. And now they want to take that failure and expand it. So this mark to model stuff is insanity. Who makes the models?
Right.
They get bonuses if they understate risk, because if you understate risk, you overstate value. So the game is always the same. You take something that sounds safe, which is a very well underwritten home loan in America. That, in fact, is a pretty darn safe asset. And then you actually pervert it into something that isn't underwritten, where it has strong incentives to inflate values. And it's actually impossible to convey to you how bad the models were in the great financial crisis. And these are the top of the line models. This is where Goldman Sachs claim to have multiple 18 sigma events occurring. Now, an 18 sigma event, a single one, that's like 3 times the life of the universe. It might happen once. To have 3 sigma events, 3 18 sigma events, is not 3 times that, it's that roughly 80 billion, once in 80 billion years times once in 80 billion years times once in 80 billion years. It is literally a number so large,
virtually
no
impossible.
one can conceive it. That's what their models did, and that's where they want to go. It's all to save a few bucks from going to honest appraisers. It is literally insane, except it's not, of course. There are powerful people that want to inflate asset values for the most obvious reason in the world. It makes them rich. It makes the rest of us poor. We shouldn't allow them to do it.
Well,
we have to be impolite in meetings, as you said, and we have to fight back.
yes, we do. And on that note, we're going to take a quick commercial break.
Today's learner has a myriad of educational options to choose from, both online and off. But for appraisers and professionals who rely upon appraisals, your high-quality, comprehensive valuation education resource should be the Appraisal Institute. The courses we offer are rigorously researched and largely developed by practicing appraisers using their real-world residential and commercial valuation experience. Go to appraisalinstitute.org/education for more information.
Welcome back, everybody. Bill, one of the things that most people aren't aware of, and I'm sure you're not unless your head is in our space on a regular basis, but during the pandemic, for several years, 50% of all loans originated out of the GSEs had an appraisal waiver, meaning they had no appraisal at all. Now that we're coming out of the pandemic, there's a lot of emphasis on something less than a full appraisal, and they're even bringing in non-appraisers to do the inspections as though that's going to save money. What's your advice to the appraisal community?
So this is an existential battle in which your self-interest aligns with the public interest, and the interest of the people pushing these ideas is completely contrary to the public interest, but very much in their self-interest as well, or at least, their patrons' self-interest in particular.
Right.
So the appraisers need to fight back, and you had, for the era, the best possible strategy with that petition in 2000. But in the modern era, you can even make it more powerful. So don't just make it a petition. Also do modern video and podcast type stuff. Find your best spokespeople and do mini interviews in which you explain what happened. Give specifics, give humans, right? We relate much better, not to numbers, even when it's thousands of appraisers, but to Fred and Mary and John telling us their story of how they tried to do the right thing, how it got replaced with this abomination that led to very substantial overestimation of value, and how people are going to lose out of that. And bring in non-appraisers as well, put some criminologists for historical stuff, put some victims of inflated appraisals, the homeowners that are going to lose their homes because of it as well. Tell your story a little bit more chronologically, how you've been fighting this and how, when you were ignored, it led to, then it's important. The appraisers before didn't just do the petition. They followed up and they sent it to the right people, but you're going to have to do even more, have to then take your story on a more retail basis to members of Congress. You're going to have to find people on key committees. This story, this fight can be bipartisan, even in the modern world. That's part of the reason I told you the story. There are plenty of people like me that are, a particular party, and we're more than happy to, rat out the rats in my party. And you need to do exactly the same thing. Just call balls and strikes. And who better than appraisers just to call balls and strikes accurately.
All right, well, then that's what we'll do. We will heed your advice. And Bill, I can't thank you enough for joining us today. And we will have you back because I'm sure this chapter is going to be reopened.
Yeah, I have to tell you this. It's not like war where you could have a decisive battle and win for all time. Every generation has to strive to do the right thing against people that have really bad incentives to do very harmful things to our country.
I understand. Thank you again.
Thank you.
Thanks so much, Bill, and thanks for our listeners for joining us. I know that they're going to get a lot of insight from this. I know it was so interesting for me to listen to it, looking back at it. Thanks to our sponsors for helping us put this on. If you have any comments or would like to be included in a future Buzzcast, reach out to us at comments@appraisalbuzz.com. Thanks and have a great day.